Hello and welcome to SwitzerTV Property. I'm Peter Switzer. On tonight's show, we see if house price warrior AMP Capital's Shane Oliver has become less concerned about a house price collapse. And then I test out the claim that office/commercial real estate is in trouble with Centuria's Jason Hulich, who says N-O, no. And then our cold-faced property expert this week is Rate My Agent's Mark Armstrong, who reveals just how happy or unhappy sellers are right now, and he tells us whether this is a seller's market or a buyer's market right now as well. Without any further ado, let's cross to Shane Oliver from AMP Capital. Well, as I said, we're catching up with Shane Oliver, and Shane, in the past, or in the recent past, was a little worried about the prospect for house prices, such that even Chris Joy put him in the Grizzly Bear class. Shane Oliver, thanks for joining us.
My pleasure, Peter. Great to be here.
Did you notice that Chris Joy put you in he actually said the Grizzly Shane Oliver?
Well, I'm going to frame that because most people say that I'm perennially bullish,
Yeah.
and he described me as AMP's Grizzly Shane Oliver. So I'll just wheel that out every time someone criticises me as being too bullish.
Yeah. No, I laughed
so
at
he's
that
done
one.
me a favour.
Yeah. I must admit, I've always thought if you're a bear, you're more like a Yogi Bear rather than a Grizzly Bear.
I think so.
All right, mate. Let's
Gummy bear. I like Gummy Bear.
Yeah, Gummy Bear. That's more like you too. Let's get serious now. You did have a worst case scenario view on the house price scenario. What are you thinking now?
Well, the worst case, I think, got blown out of the water by the JobKeeper bank payment holiday and various other things that came along soon after I put that note out. So the worst case was for unemployment to go north of 20%, for price and that to put big pressure on the property market, with property prices falling around 20% or so. Now, JobKeeper, I think, has kept a lot of people in jobs, kept the money flowing. We've also had an increase in job seeker, which has helped, but not the major factor. We've also seen the bank payment holiday. So a lot of the things that were going to give that worst case scenario haven't happened or have been headed off. In the meantime, though, I think we're still going to see elevated unemployment for a while longer. So once JobKeeper does come to an end, that might lead to some problems for some households. We've also seen a big hit to immigration levels, which will act as a negative on demand for housing. And then finally, we've seen the weakness in the rental property market, which might put some pressure on investors. So all of those things suggest we've still got some downside in prices ahead of us, but I don't think it's going to be that worst case scenario I originally had of 20%.
Just ahead of the release of the May unemployment numbers, if they come through, I should ask you, what are you expecting? And then if they come through better than what you and the consensus are expecting, would that change your view on what might happen to house prices?
Well, what I'm expecting, I don't have a lot of confidence in, because, I mean, on the one hand, you could argue that there's still been some weakness in the jobs market, and therefore we've factored in a decline in employment of around 70,000, taking the unemployment rate towards 7%. But by the same token, we've seen out of the US, we've seen out of Canada, we saw a month ago that the jobs figures haven't been as bad as feared. So maybe I'm too negative going into this. I think at the end of the day, JobKeeper and JobSeeker are doing a fantastic job of stopping the headline unemployment rate going up too much, which was precisely what they were partly designed to do. They were designed to provide a bridge across this coronavirus chasm, so to speak. And they've done that. They've kept a lot of people in employment. When people have got JobSeeker, they haven't had to look for another job, so that's kept them out of the labour market and kept the headline unemployment rate down. Don't forget that people were talking about 10% unemployment, 15% unemployment. I think that's largely been headed off. And so those things have done a good job there. I think the problem is economists have is trying to work out precisely how all those things interact, and that I think has proven very difficult. the true picture will probably only become clear later this year when JobKeeper ends and JobSeeker goes back to a lower rate and the normal rules around JobSeeker return. Then we'll get a handle as to what the true unemployment picture is. And I suspect it's going to be higher, but it's probably going to be around 8%, not the 15%, not the 10%. So if you imagine if we didn't have any of these things, the unemployment rate might have gone up to, say, let's say 12% presently. And as the economy comes back, and it's coming back quicker than even I thought it would, probably quicker than you thought it would. And when you look at most economic data, so a lot of jobs are coming back. As soon as I go out there and spend, if I go into a retail shop and spend, that shop was closed a month ago. Now it's open. I'm talking here from experience. And the lady in there is trying to sell me some winter clothing, was saying she's just flat out. And there was a queue of people in front of me for me to get to pay for my jacket, and there's a queue behind me. So people have been employed again, and that takes them off JobKeeper, off JobSeeker, or off the unemployment lines, wherever they've happened to be, getting employed again. So as employment comes back, therefore, I think the true unemployment rate is now coming back down. So probably got up to 12, 15%. Now it's probably coming back down, regardless of what we see for the May figures. I think the true number is probably trending down. By the time we get to October, it's probably around 8% or so, which is great, nowhere near as high as it could have been, but that's still going to lead to a little bit of stress for some households.
Shane, you and I both know that there are negative types out there who you could, if you want to be nasty, call them doomsday merchants, and they don't like to be called that. They would probably call themselves realists, but these realists have seen their very negative forecast on house prices and their view that there'd be a collapse of property prices and the sector for quite some time, and they've been wrong for a long time. If, as a consequence of all this stimulus, we see very strong growth in 2021, are these people who are, let's call them, in the nicest possible way, doomsday merchants, are they going to have to be waiting again a long time before a collapse comes, which would probably be linked to a conventional recession where unemployment goes to very high levels and governments and central banks aren't able to respond like they have this year?
That's probably the case, and that's probably going to turn out to be the way it goes. I still see prices coming down. They have come down already, and they're continuing to come down this month, according to the CoreLogic data, which seems to have been resurrected on a daily basis. But I think the falls national will be in the range of 5 to 10%. Now, if that happens, we just go back to where we were around the middle of last year. We just give up some of that recent gain, and then we'll start to rise again as immigration comes back, as we've got low interest rates, as the economy recovers. House prices will rise again. But we've seen this story now for a long time, particularly starting, I think, around 2003. People saying there was too much debt amongst Australian households. House prices were way high by global standards. There's going to be a crash. And I can agree with some elements of that. I can agree there is a problem with too much household debt in Australia. I do agree that Australian house prices are high by global standards, and that makes it very affordability is nowhere near as good as it could be for younger Australians trying to get into the property market. In fact, it's quite poor. But to get a property crash, you really need a situation which triggers Australians being forced to sell their homes en masse at a time when there's no buyers, and therefore prices come crashing down. And I think it's still hard to see that, where you get a 30% fall or a 40% fall. It still seems hard to see that. But I think in 2 years' time, if we haven't seen that, if all we see is a 5 to 10% fall and then we go off again, I think the what you call the doomsayers will still be back again. They'll still be saying that Australian housing is expensive. They'll still be saying that household debt is high, because you can say those things. So the story will just keep going on like a broken record, as it has for the last 16 years. Yeah,
and I guess, Shane, the threat to the housing sector might come. I know one economist, Michael Knox up at Morgan's, said that there's a possibility that we could see a bit of a rerun of the Roaring Twenties because of so much stimulus, and particularly if there's not a second wave infection, all the stimulus could create a lot of economic growth, and over the next 2 or 3 years, we might see inflation come back, we might see interest rates start to rise, and that could trigger some real problems for those people who are carrying too much debt, particularly, I guess, if there's not strong economic growth at the same time. It's like there is growth, but if a lot of that growth is also inflationary, we might get back to a more conventional situation where a recession comes because of higher interest rates.
Oh, it could be, but I reckon that's a fair way off. I think the analogy to the Roaring Twenties is one that we can't ignore, because just imagine how people were feeling in 1918 or 1919. They were probably feeling kind of depressed. There would have been a lot of people out there. There wasn't as many economists back then, but there might have been a few out there saying, "Oh, gee, this is going to change things forever. You know, growth won't return." And then, lo and behold, along comes the 1920s, and it's a roaring decade. So that's the way things often happen, that they end up surprising. You know, out of misery comes something which was quite good. Out of World War II came the post-war years, which were fantastic.
And the Spanish flu as well, Shane.
Sorry?
And the Spanish flu as well in 1918.
That's right. So, you know, in 1918-19, there was that misery around Spanish flu. But if you got yourself too carried away, saying people were never going to spend again, no one wanted to mix in public again, no one's going to travel again. And then, of course, you missed out on the Roaring Twenties when, of course, the exact opposite happened. So, yeah, you can't ignore that analogy, I don't think. But by the same token, I think it's going to take a while before we use up the spare capacity that's currently around, and therefore it's going to take a while before interest rates really take off again. Like if you imagine the situation today, it's a bit like the unemployment rate. You're trying to get a handle on what the true unemployment rate is. It's the same with the cash rate. The RBA normally in a recession cuts the cash rate, say, 400 basis points or something like that. They've only been able to cut 0.5% because we've now banged up against what they call the lower bound of 0.25%. They don't want to go negative for good reason. But if there wasn't that constraint, they probably would have gone down to minus 3% or something like that, minus 3.5%. And it would take a while to get down to that level. We may not get down there till the end of this year. And then we'd start to gradually rise. But by the time we get back to 0.25%, I reckon would be about 2.5 years' time before we get back to that point. And therefore, given that none of that's happening, we're stuck at the 0.25% level, it stands to reason that the RBA isn't cutting. That's because we're at the lower bound. If they were cutting, we'd be going down. They'd only be in a position to start raising rates again, probably in about 3 years' time. So, yeah, I mean, somewhere out there could be higher interest rates, which could cause problems for households, but I reckon it's a fair way away before we get there. The other thing is that the Reserve Bank, we had this debate a few years ago, the Reserve Bank's not going to mindlessly raise interest rates to some preconceived notional level, normal level it should go to. It will do it very gradually. If there is a problem with inflation picking up, it will raise interest rates 0.25%, see what happens, 0.25%, see what happens. It won't just keep jacking them up to 13% or whatever, causing a crash in the economy, because that's not what it would want to be doing. It would just want to be keeping inflation under control. So therefore, I don't think it would raise rates so far that it causes a massive property crash.
Well, Shane Oliver, as always, it's great to catch up, mate. And I hope you're right this time.
My pleasure. Thanks, Peter.
Well, the coronavirus has made it really challenging for anyone in the real estate space. And a company that we've talked to over the years, of course, is Centuria. And we've got the co-CEO, Jason Ulich, with us right now. Jason, great to see you.
Thanks for having me.
How has the coronavirus challenged your business?
Yeah, look, I think it's challenged most businesses. I think luckily for us, we're really well placed heading into Corona. So if you look at our portfolio, the three sectors we're in are commercial office, industrial logistics and healthcare. So we don't do retail, we don't own shopping centres, which has obviously been the hardest hit. Yeah. Also, we had very high occupancy rates. So the office and the healthcare were sitting about 99% occupancy, and industrial was about 97, 98%. So most of the buildings were really full. Yeah. And probably the other big thing for us was the tenant base we've got. You know, we've got a really strong tenant base in those buildings. So in the office portfolio, 75% of the tenants are government, which is our biggest tenant across the portfolio, state and federal. Then we've got ASX listed and we've got multinational. So they make up the vast majority of our tenants. So really the only retail tenants we had were ancillary retail, which were the gyms, the cafes, the small shops underneath the office buildings, but they make up a very small percentage of our overall income. So obviously all those smaller tenants, the ones that had issues, obviously we're helping out through the code, and the government's put a good structure in place.
The code, explain to my viewers what you mean by the code.
Yeah, look, the federal government came out with a code of conduct between landlords and tenants. And then each state legislated their version, which was all very similar. But basically, if you're a tenant or a business with under 50 million of turnover, and you suffer a decrease in revenues because of COVID of 30% or greater, then the landlord has to work with you to give you rent relief. So for example, if your revenues have gone down 30%, the landlord has to reduce your rent by 30%, and half that is just rent free, so it's gone, and half of it's deferred rent, so that's made up over the rest of the term of your lease. So if you're a big company and you're over $50 million turnover, it doesn't apply, and you're still on the hook to pay your rent. So having those big tenants really helps cash flow.
And so what you're saying is that as a company, you're more exposed to bigger tenants, 50 million plus, therefore you're not being pressured revenue-wise from the rents you collect.
Correct. So the smaller tenants probably make up 5% or less of our portfolio.
In terms of the outlook, of course, the economic outlook's going to be important, but given what you've said already about the nature of your tenants, are you expecting 2021 to be a much better year than 2020?
You'd think so. It'd be hard to be too much worse as a country
Yeah.
and as globally. But if you look at I think the big thing is the sectors, and each sector is a bit different, right? So if you look at something like probably the hottest sector coming into COVID and coming out of COVID has been logistics and industrial.
Yeah.
And we've got the largest sector-specific.
And these are businesses that like supply groups like Amazon and all the online businesses like
So these are all
Kogan.
the big warehouses, basically. And we've got the largest listed pure play industrial REIT on the ASX, Centuria Industrial REIT. And that market is strong. And what's happened obviously with COVID is e-commerce has probably jumped 5 years ahead of where it was with take-up because of COVID. And it means it needs these warehouses to pump out the goods to consumers, right? So you've got really strong tenant demand, and then you've also got very strong investor demand for industrial as an asset class. So you're seeing some transactions take place post-COVID, so in the last few weeks, that are at yields and cap rates that are the same as or lower than they were pre-COVID. So the demand has increased for industrial property, and it's seen as a very safe sector to be in.
So it's becoming like a defensive asset.
Very
now.
defensive, and just the views on e-commerce and its take-up has really helped the demand for that asset class. So then you move to something like healthcare, which we've been in for the last year or two. So we own a lot of medical centres, day surgeries and the like. So when elective surgeries were cancelled for a while there, obviously a lot of those shut down. But because of the backlog, once they reopened up, they've probably got 18 months of make-up of those surgeries. So they were going to be trading really well. So again, healthcare as an asset class hasn't been affected at all, and there's still a lot of demand for those assets.
And obviously you're not getting demands for rent relief from those.
No, again, if there's a cafe in the medical centre or something like that, but all the big groups like the Heliuses and a lot for the not-for-profits and so forth, they're back operating and they're busier than they've ever been. Then you look at something like office. There's been a lot of negative press if you read the paper, the death of office, and no one's going back to office space, which we don't really agree with at all.
So why don't you agree? Personally, I do too, but it's a gut feeling that people will want to get back in the workplace. A lot of bosses won't want. Look, I think some bosses will look at their staff and say, so-and-so and so are pains in the butt. They can work from home, but everybody else I want back in the office.
Exactly. Look,
you will do that?
Look, I want most of our guys back in the office.
Right.
But if you look at it, there's a lot of reasons, right? We're social creatures. You think about working from home. If you've got a home office, it's very easy. But a lot of young staff are flatting. They've got 2 flatmates. They're at the kitchen table, and working from home for 3 months is not that easy, right? So we're very social. The whole collaboration piece is a lot harder online. Look, the tech through COVID's been pretty good, and we've got great systems at Centuria, but you start to get sick of it. It does drop out. Some people's Wi-Fi aren't as strong as others' signals. But I think the 2 big things that I think are happening is, one, activity-based working was a great thematic for the last 10 years. So if you go back, 20 years ago, everyone had an office, and you had about 20 square metres per space per employee, right? Activity-based working came in, okay, and probably now it's closer to 10 metres, 8 to 10 metres. So basically, over the last 25 years, where you needed 20 metres per person before, now you need about 10. So it's halved. Now, in the last 25 years, the office sector has been performed extremely well. So even though space is half what people actually needed, right? Secondly, with the whole COVID play, a lot of the big fit-outs, nearly all big fit-outs were going activity-based pre-COVID. And what that meant is you probably needed about 30% less space than a traditional fit-out that wasn't activity-based. So activity-based is desk sharing. End of every day, everyone packs away their computers into their lockers. Next day they come, sit wherever they want. And because people are on leave, people are travelling, people are sick, whatever, you need about 30% less space. I think what you will see with new fit-outs post-COVID is there'll be less groups doing activity-based. Now what that will mean is they'll need 30% more space, right? So I think net with, there will be some more people working from home, but net, I don't think there'll be much difference in the office take up at all.
I wonder if you have, as tenants, those sort of nerdy IT businesses, that's where you might see a little bit more working from home, because a lot of those people don't contribute anything to anything else but what they do in their little cubicle.
A lot of them were set up from working from home, and that could expand for those groups. But I think one of the big things, I read an interesting article from the CEO of Brookfield, who's probably the biggest office owner in the world, and it was about culture. And it was just so hard to get that culture right online as compared to having the office meetings and so forth. And I agree with that. So, look, I don't think it's the death of office by any means.
It's interesting. I read the book by Mark Randolph, who was a founder of Netflix, co-founder. And he made the point that there was a great IT worker whose girlfriend had moved to San Diego from where they were in Santa Cruz. And he said, I want to work from San Diego. And Randolph just said, well, if you actually think you can be as productive in San Diego, go there. The guy didn't go. He actually made the objective observation that he couldn't be as productive.
And the other thing is the younger employees coming through, so the guys and girls out of university and so forth, I think it makes it harder to learn and also mentor and so forth if they're not in the office soaking it up, listening to conversations and just being part of it. So I think there are a lot of negatives from not being in the physical office space. But look, things will change. There'll be more flexi space, and there are other thematics that will flow through. But I think we'll still be coming to offices over the next 20 years.
As you well know, Jason, I've very sort of asked the questions you actually put forward as a possibility. But this one is interesting. So Centuria's unlisted property funds are leading the top 10 performing core funds. Gee, I'm surprised you actually tell me that. From the Property Council of Australia for 15 consecutive quarters. How does your unlisted offering differ from others?
I'm glad you asked that.
Yeah, I'm sure you are. But look, the bottom line is you've got a good run on the board. I guess the question is, how come?
Yeah, look, we have got a really good track record. So the index that you spoke about, that sort of compares us to other competitors in that unlisted space.
And explain what unlisted means.
So unlisted is a property fund that's not listed on the stock exchange. So it's not one of the big REITs, like one of our industrial or commercial REITs. So it's either a single asset fund, so we might go buy an office building.
Yeah. Which you often done that in the past.
The building we're in was one of our funds some time ago. So we buy an office building, we'll have investors come in, mum and dad investors, super funds and so forth, and we'll own that asset for 5 years. Every month they get a share of the rental, so they get a return coming into the bank account every month, and then after 5 years we'll sell it, and hopefully we've...
Or not, because sometimes you don't.
Or not extend it if investors want to extend. And then we'll sell it hopefully for a profit, because we've added value by refurbishing it, getting the rents up, getting better tenants into the building, and then they possibly get a profit as well. Or it could be a diversified fund, so we might have a group of assets, a portfolio of assets that these investors invest into. But the big thing is it's not on the stock exchange. It's an unlisted fund.
So why have they done well?
Look, they've done well, I think, for a number of reasons. I think if you look at a lot of the funds that we've put together, we've gone into areas where we've sort of picked the location before it took off. So We've gone into places, suburbs or precincts, something like the Australian ATP, Australian Technology Park, just on the fringe of Sydney, between here and the airport. Now, we bought the first commercial building in there that wasn't government owned, and back then it was Redfern. A lot of the big tenants would not go into that location. It was sort of very fringy. The rents were really low. So when we looked at the first asset in that park, the rents were lower than we were getting in Parramatta or Chatswood. And this was one station out of Central. Yeah. So we thought, it's so close to the city, at some stage that park's got to re-rate, and there'd be a lot of demand to get into that park. So we bought the first asset very cheap. We bought 3 more assets very cheap in that park. So we had 4 office buildings, biggest owner in the park. And then the government put the park up for sale. Ourselves and Mirvac bid for it and won it. Mirvac then built CBA's new headquarters out there, 100,000 metre building. And then some of the very large institutional investors came into the park. By that time, it was called Everleigh. You had AMP, Australian Super, Mirvac, all these big institutions investing into the park. Became institutional grade. The rents doubled. The yields reduced, and the values went up dramatically.
Okay, so and we've been watching you for a number of years, and you've seemed to be good at picking a building, like the example you gave, and then they do well. Then about a year or so ago, you were saying the supply of those potential buildings are a lot harder to find.
Sure.
After coronavirus, do you think that there may well be some opportunities because people are saying, oh, well, they might disagree with you, less people want to be in office space, so therefore you'll see opportunities?
We haven't seen anything come out as yet, and there's some industrial transactions happening, but there's not a lot in office over the last month or two. We think there will be some opportunities, and where they probably will come up is assets that need some work, and this has been where we're very good. We've got a big in-house team for asset management, property management, leasing. So where a lot of groups would outsource that to one of the agencies, we have all those teams in-house. And what it means is we can buy buildings like this building, which we bought with 20% vacancy, needed a lot of work to the foyers and the arcade. So we came in, we spruced it all up, and we leased up 20% of the building. So I think where there'll be opportunities is where the building needs a lot of work because it might have a lot of vacancy coming up into a harder market post-COVID. And I think they are the ones where we'll be trying to target. So buildings with either existing vacancy or short lease terms, where the owner's scared of they might lose a tenant, they might have a lot of work to do to reposition that building to get it back up to scratch. Okay,
so going forward, what are the parts of the property market do you think look good and the ones that will be or remain challenged?
Sure, so look, as I said before, industrial, we expect to keep powering along. Our listed REIT, the demand for that's really strong over the last couple of months as we've coming out of COVID. I think office, there'll be opportunities, but we'll have to pick the markets and the assets because there'll be some assets you just won't want to be in and others where there will be opportunities. Healthcare is that new sector that we really like. So we've got 50 healthcare assets.
And it's new for you in a sense.
Yeah, so we bought a majority stake in a healthcare company called Heathley just over a year ago. So 50 assets around the country, everything from medical centres, day hospitals, private hospitals, dementia care, things like that. And obviously with the ageing population and chronic disease, that's a no-brainer, and we think we'll get a lot of growth out of that sector. Look, retail's the tough one, and look, I'm glad that we're not in retail. It is a difficult, it had structural issues coming into COVID, and that's been increased obviously coming out. So I'm glad we're not in there. There'll be some people that will make some good money out of retail, but there'll be a lot of assets that really suffer coming out, just with the whole e-commerce thematic.
Okay, Jason, thanks for joining us.
Thank you.
Jason Hulich, CEO at Centurion. Well, a few weeks ago, we checked out with Mark Armstrong, CEO of Rate My Agent, to see how the sector was going. Mark was not as negative as some people were negative about the sector. He copped a few brickbacks in the age of feedback TV and feedback media. But at the same point, he's got the courage of his convictions and he's back again. Mark, thanks for coming on the program.
Pleasure, Peter. Thanks for having me.
Yeah, anyone who's an optimist when doomsday merchants want things to fail always gets bagged as being a spruiker or something like that. But Mark, what are you seeing out there?
Yeah, look, we saw, last time we spoke, Peter, we saw rapid growth in vendor happiness. Through 2019, a lot of sellers were getting prices above their expectation, and we're very happy. And I think, we always expected that happiness to level off in 2020. It was never going to continue those sorts of heights. And we saw up into the end of Feb, we saw vendor happiness reasonably robust and holding its position. But then April, we saw it adjust. And as we all know, COVID is really what impacted the market in April. We didn't see a massive adjustment. We saw it adjust down by 5% nationally. So it's still held reasonably firm. And I think we just still need to watch in the coming months to see really how much impact COVID has on the market, between now and the rest of the year.
When you use the word happiness, how do you measure happiness?
Yeah, more money. I think that's basically we measure happiness by we get thousands of reviews at Rate My Agent, and the last question we ask someone who's sold a property who's posted a review, we simply ask them, is the price you achieved above, below, or in line with your expectations? So we link people who say that the price they sold for was above their expectations. Well, they're happy. They're more likely to be happy, so they sold above, and that's really the metric. It's a really powerful metric because it not only tells us that property's selling, but it's actually tells us how strong the market is and how well properties are selling.
What do you do? Obviously, that's a part of your business, but you obviously would be looking at the other numbers that are out there. I must admit, on Sundays and Mondays, I look to see auction clearance rates in places like Melbourne and Sydney as a bit of a barometer of what's going on. I presume you do the same kind of thing as well. Looking at other indicators, what is your conclusion about property markets at the moment?
Yeah, look, to go on to auction clearance rates, I don't take a huge notice of auction clearance rates, or don't emphasize them as much. I mean, first of all, if we look at the entire market, auctions are really dominant in inner urban Melbourne and to a lesser extent, but still in inner urban Sydney. But the majority of property is not sold via auction. So we've got to look at the broader market. The main one for me is around supply. I mean, supply and demand are the two natural things that we need to look for. And if we look at what happened in 2019, one of the reasons the market was so strong was because supply dropped by 20% throughout 2019. There was uncertainty, that we had an election in early part of the year, and there was a bit of uncertainty around the market. So sellers really pulled back in 2019. So that was really one of the main reasons why we saw strong market growth in that year. We feel the unknown is where supply is going to go for the rest of 2020. If you had have asked me pre-COVID, I would have said that there's no doubt we're going to have one of the biggest spring markets we've had, because those buyers who decided not to sell in 2019 will ultimately come onto the market. That's the unique thing about real estate is family units grow and fall, people die, people get married, people get divorced, people have kids, people leave home. That doesn't change regardless of what the economy is doing. The demand to move and transact property is always building. So that pent-up demand of buyers who didn't sell in 2019 is always going to come to the market at some stage. And we still feel reasonably confidently that Australia is handling COVID really well, and we feel that supply of property through that spring market is going to lift quite dramatically compared to 2019. So I think supply is a major factor.
And do you think the buyers are going to be there looking for properties?
I think there's that uncertainty. I think we've got to see a little bit more about how COVID really impacts the market, how quickly unemployment stabilises and people get back to work. We suspect that vendor happiness will adjust downward in the second half of this year. We don't expect it will be a dramatic fall, but it will certainly adjust, and that 5% drop in April is an early sign that we expect it to level off and drop, and that will be because the supply and demand curves turn the other way. Demand will soften, and supply will lift.
Where are the happiest vendors and where are the least happy vendors?
Well, the happiest vendors tend to be the people in markets where there's a higher level of affordability. You know, in markets where we actually saw an increase in happiness in Queensland and WA in April. Now, WA is a bit of an extreme case because it had a very low base of vendor happiness to start with, so it was the lowest, so it only grew by 1%. But we tend to see those regional markets and those more cheaper properties tend to stabilise and be a little bit happier. And we saw the opposite. It was absolutely the $1.5 million plus range in Melbourne and Sydney. This is where we saw vendor happiness drop off a cliff. It fell by around 20% compared to the last report. So you know those top end properties tend to have a more volatile market. Demand can be more volatile in that market. We don't have a huge section of the population that can afford properties over $1.5 million. And we also have people who may well have had really strong growth in dollar terms in 2019. And the psychological adjustment that they're needing to make now as the market softens a little bit, in dollar terms, can be quite a big adjustment that they have to go through. So that $1.5 million market is a little bit unstable.
So for the people who are watching this who are thinking about selling their property, is it a good time to sell now, or would you be a waiter? Would you wait for maybe getting into September or December quarter?
Yeah, definitely wouldn't wait till spring. I mean, it depends on the time frame. If you want to sell your property this calendar year, get your property on the market now, or June, July, August, it would be the time to get your property on the market. You're getting into you're selling in a market where there's still a reasonably low level of supply. There's not a lot of property out there. You're not competing with a lot of vendors. So absolutely very, very clear. June, July, August, if you're looking to sell in 2020. If you're looking to buy, I feel that there'll be some good buying opportunities through September, October, November. So sellers market through winter, buyers market through spring.
Right, Mark, is there any other factor out there that you think is really important that people should consider when trying to assess this market?
I think that supply factor is the most important one. If you're looking to sell, is getting into the market when you're not competing with other people. It's a very hard thing to do to buck the trend. You know, everyone tends to, no one else is selling, so I better not sell. Or no one else is buying, so I better not buy. But when no one else is selling, sell. When no one else is buying, buy. I think psychologically, it's a hard thing for people to do. But if you've got the courage to do it, that's certainly the right time to do it.
Mark Armstrong from Rate My Agent. Thanks for joining us.
Pleasure.